Hey guys, welcome back to the Capital Mindset Show. We are your hosts with the most, Austin and Fabio, and today we're going to be looking at HPQ and HPE. We're going to be kind of summarizing what the business is, who its customers are, what it's selling, the financial position, and then we're going to be plugging it into our discounted cash flow model, as well as offering some of our own thoughts. This is one of our preliminary analysis. This is not a deep dive video. So without further ado, let's jump right into this. What are we looking at here today?
All right, so as always, let's take a look at the price action. We're going to begin with HPQ today. So both of them are Hewlett Packard. You might see that in the name. So you'd be like, oh, this is the same company. However, while they are kind of like the same lineage, they are not the same company anymore. So HPE was spun out of HPQ, the traditional Hewlett Packard company, in an effort so that the business could focus more on enterprise solutions, and while the other one could focus on more traditional business. So when you think of HPQ, I want you to think of laptops, printers, all of that stuff that people tend to think about HP. So when we get to HPE, we're going to talk about a little bit different product line. Okay. And then at the end of the day, if you decide one of these is maybe interesting for you, maybe it'd be the different businesses that they're involved in. I kind of probably willing to bet that that's what's going to be the differentiating factor for most people. All right. So looking at HPQ, let's take a look at the price action over the course of 5 years. Well, I said 5 years and I hit the max. Well, so
it happens sometimes.
They performed, I mean, right here, they performed about 159% over the course of 5 years. Not too shabby. A lot of that gain can be attributed to post 2020. So after the pandemic. So it just kind of exploded out of there because I guess more people wanted to buy laptops, work from home environments. So people, buying a lot more personal computers, stuff like that. And HP stood to benefit. Printers, you buy printers for your home, stuff like that. So that's something we can think about going forward when we look at their presentations. And if you see, this has been a compounder over the long term, returning 14,000% for shareholders. Fantastic. They pay a small dividend. On a PE basis, they look decently cheap. We'll see in our model. So let's take a look right now at some of the announcements for the business. So again, this is the sales pitch of the business. We want to highlight that. Okay, so if we look through this and we're not interested in anything, that's a red flag because this is supposed to be the highlight reel of the business.
Yeah, this is basically what management is highlighting to investors in these sorts of things. So
yeah, exactly. So right here, immediately, I can see that they are telling us that there was a free cash flow of 0.9 billion for the quarter, but that excludes the cash that came in from the Oracle litigation. So I think that that's going to, we don't want to dismiss the 1.8 billion because that is cash. Cash is cash, okay, at the end of the day. But it is going to be probably less going forward. It's not going to, we can't assume that they're going to sue and win every single time or when a company's involved in a lawsuit, we don't want to assume that will be forever.
Yeah.
We know that they're returning capital to shareholders. We'll take a look at the model to see whether or not they should be doing that because capital allocation strategy is very important. We want to actually agree with management. And if we don't agree with management, we don't want to invest because I want to be investing in companies that I'm in line with the vision of management. Does that make sense?
Yeah. So now kind of asking now after we sort of go through this presentation a little bit more, just sort of getting back to the basics. What does Hewlett Packard do? What does this company specifically itself do? What does it sell? Who are its customers? I'm sure that we're going to be getting all of that later, but that will help color exactly. That'll kind of provide the background for then what management is doing and how management is executing on management's vision. So those are just sort of some of the questions that I have after we end up going through this and sort of seeing now what management is trying to highlight to us.
Like I said at the very beginning, this one sells printers, laptops. That's what you got to think about. You can see that in this picture right here. That's what you think about. About this is the HP most people think about. All right, we'll get to the other one. The other one's a little more complicated, but this one's fairly simple. Printers, laptops, tablets, stuff like that. All
Yeah.
right. Gaming PCs as well, by the way. So we see their different segments, right? So printing, personal systems, and corporate investments. So think of this.
Interesting. Yeah.
Yep. So think of this and separate this in priority of what you think is more important. But personal systems is their largest. And then we got printing over here. And then corporate is the smallest. Okay. So right here, we see a growth rate of 1.1%. Printing is a very mature business. That's what to be expected. Personal systems, this is what's been growing. If you think about it, it makes sense. Work from home environment. A lot of people need computers to go home, laptops. So they're going to be probably buying more and more and more. So we take a look here at the non-GAAP operating profits. We see that printing is still actually the most profitable, right? Because look at that. Look at the revenues versus the operating profits. And look at the revenues over here versus the operating profits. So, and they tell it to us right here. This is perfect, easy for us to really work through. Again, we're going through this with you guys for the first time. So it's beautiful that they do this math for us so we can visualize that. And then that gives us a total of 8.1%. So, not too good, but like the printing, the mature business is the most profitable part of the business. Okay. So going forward, let's take a look here. This is, I guess, on a yearly basis, same kind of numbers here. And so again, we can see personal systems, higher revenue, but lower margin. So we actually prefer the printing part of the business. The printing part of the business is what we refer to what, Austin?
That's their most, yeah, that's their cash cow. That's the most profitable part of their
Yeah.
business.
That's
Yeah.
non-growing, just spitting out cash that they can do whatever they want with it.
Yeah.
All right. So taking a look over here, we see the disbursement across the world. So we want to see diversification in this case. And we do see that Americas is 40%. And the rest of the world actually makes up a larger portion of that. We see that Europe is growing faster than the United States. The United States is growing very slowly. So you can see that HP is doing more business elsewhere and it's growing faster than the United States. The United States is a mature market. So what we want to see here is operating profit. The majority of it is the printing. And again, they're showing us the margins, high margins, highlighting that. And again, that's the cash cow from which they can take that cash and reinvest it in other parts of the business. And I think this is going to be the yearly numbers. Yep. So anything else that we really want to look through here, we're going to look through it. Revenue, cool. Okay. So it looks like I'm just going to skip over to the model and we're going to talk about it. So this one is HPQ. So let's go to the HPQ model. So if we don't assume any growth, it's actually not too far off a buy. Okay.
No, it really isn't.
Exactly. I don't think they're going to be doing the same level of buybacks as they did in the past. But they've averaged out. They've really deleted shares. Okay, so
yeah, which is interesting. Immediately, my mind jumps to why are they buying back so many of these shares? Why are they, as you just put it, deleting shares? These are some questions that I'm asking myself now. And then also, too, if this is a company where you would care about book value in this instance, are we seeing a price that is close to book value now? Like these are just some preliminary questions I have coming into this model right now. So.
Yeah. So this business is utilizing an absolute asinine amount of cash to just buy back shares. We presume because the management thinks it's cheap. Now, do we agree with management? That's a different story. We'll find out. But I think just looking at this, if I were to assume zero growth, it's close to a buy. And management was probably buying back shares at cheaper prices because we have to remember. Let's go back and see what happened. So HP stock has actually roared up. So management was buying around here, around probably all throughout this time period, right? So cheaper prices than where it stands today. And so probably I would assume from that management did a great job. Okay. They were buying at cheap prices. I do think the stock was cheap. Going forward, the stock still may be cheap, right? But let's tone that down a little bit. And so let's applaud the management for great capital allocation on their part. And they bought back shares when they were meant to. They buy low, not buy high. A lot of companies buy high these days. So we got to applaud management when they don't do that. Okay.
Mhm.
And looking down here, we noticed that they were cheap on a PE basis, but they're also very cheap on a price to free cash flow basis. So not only are on a GAAP net income basis, but on a cash flow basis. Um, Analysts, funnily enough, a lot of these videos we do, we look at analysts, and sometimes the ones we don't like, analysts say to buy. And then the ones we kind of might like, they don't really like as much. So the analysts say it's a hold, and have a price target of 36, implying nearly a 7% decline from here. So that's there. I want to take a look at some of the key ratios, and then we're going to jump right back here and then do our valuation. But
Yeah.
let's take a look at real quick some of the liquidity and solvency ratios. So taking a look over here, we see something interesting. So the debts kind of remained more or less the same. I'd probably have to take a look closer at that. The liquidity ratios don't look too good. Again, I'd have to probably take a look at what's going on there. Gross profit margins, decent. Return on equity, that's probably something's going on with the equity number. It might be
Yeah,
employment.
if I'm looking at this now, apart from that, I was actually just wondering that as well. I was wondering if it was like an absolute value type of thing. But what I'm kind of seeing here now, what I'm kind of piecing together is that this is a relatively good business, just not exactly in a great financial position at the current moment in time. That's sort of what I'm just seeing here. Just these are where my thoughts are just immediately sort of guided towards as I'm looking at some of these key ratios, as I'm extrapolating a story from some of the numbers that I'm looking at here right now. So
Yeah, I mean, I don't think it's necessarily in a bad spot. It's more like the liabilities, right? So take a look here. You see that? The total
mhm.
debt ratio. This is where, again, drive a story from the numbers, Austin. Well, you said that they have a bad balance sheet. Look at the total debt ratio. Looks bad. But
Mhm.
look right here.
Yeah, it's true. A lot of it's also the current ratio, the cash ratio. I'm seeing a pretty significant
Yeah, but
trend of a
look at
current
look.
ratio under one.
You should,
It's just-
but pay attention back to this. Remember, do
yeah.
not look at numbers and say, "Oh, number bad." You know, we got to derive a story,
Mhm.
context. I'm in this video. Hopefully, this shows everyone what I'm deriving from these numbers. They're telling me a story. I'm just looking at them, and then they're speaking to me. So the total debt ratio, what that's telling me is that they have a lot of liabilities, right? But that's not necessarily debt, right? They have to record liabilities for a variety of reasons. If you ever study GAAP accounting, you'll learn all the things that get recorded as assets or liabilities. And what we can see here is that presumably they have a lot of long-term liabilities. And also looking at the liquidity ratios, they have a lot of short-term liabilities, right? Relative to current assets. Now, not all those liabilities are necessarily cash payments. And I'm trying to guide you onto what it is. And I already know what it is. And I have not looked at the balance sheet. I have not looked at it, but I already know what it is.
Accounts payable. Could that be? No, no, no. What is it then? What do you think it is? Or
A
what do you know it
mixture,
is?
a mixture of a bunch of things, but
Yeah.
accounts payable, unearned revenue, stuff like that. Especially if they're doing agreements with companies, right? So that they get a contract, they get payments from companies, and they have to deliver all the products. So that would increase the liabilities. The liabilities would go up. So, but I'm looking at the debt, and the debt's not the problem. The debt is not the problem. And the debt is usually what I look for. So by the debt not being the problem, you see the debt's really low. I'll highlight that again here. So if the debt's really low, then on the liability section, I don't think it's not them owing other people money. That's not the problem. It's most likely them owing other people services, right? Or that they have some bills that they have to pay. But it's more mainly probably like the services. Okay, but it's not debt. Okay, so it's not as bad as what we think, and then therefore the equity is probably negative. The equities in this case is negative. That makes sense because if we look at the liquidity ratio, it's below 1, which means they have more current liabilities than current assets. And then looking at the total debt ratio, it is also above 100%, which again means they have more liabilities than assets. Therefore, the equity is negative, and therefore it's yielding that return, right? So it's giving me a negative number. So everything makes sense now, right?
Mm-hmm.
Anything you want me to brush more upon? But do you understand what the numbers, they're speaking to me, and that's what they're
Yeah.
telling me in the story.
Yeah. Yeah. Now
So is it
I'm
a
actually kind of
problem or is it
seeing
not a
where,
problem? What do you think I'm leaning on?
knowing you're likely going to say it's not a problem in this instance. But me, I would need to just see a little bit more, if that sort of makes sense. I would need to see just exactly the way these numbers are broken down on their sheet right now. But that's also just me too.
Well,
So
but I hope I at least drove the point that you can't just look at ratios and go, ooh, number up bad, good, number down bad. You
yeah.
gotta do more than that. You gotta take us drive the story from the numbers, and the numbers are telling me a story. So
Mhm.
looking down at the gross profit margin, great, going up, operating margin going up, cool. I don't care about the rest. All right, let's take a look at the earnings quality. Earnings quality is not too good. It's just there. It's almost there. So it improved, and then it's kind of got worse, but it's just under. Okay, unfortunately. Yeah, that is a real shame. But what can we do? And then book value per share, don't care. All right, let's move on. Cash conversion cycle, great. It's negative. Awesome. So yes, that actually coincides.
Mhm.
They're getting the cash quicker than like the sale. So it's converting very quickly. It's converting on a negative basis. So yes, they probably have a lot of unearned revenue right there.
Interesting.
See, the
Wow.
numbers are
Look at
telling
that.
me a story. You see, the
Yeah.
numbers, they confirm things. I haven't looked at the balance sheet yet, but they're telling me the story right there. All right. So let's go to the valuation, right? So we're discounting it at 20%. A lot of uncertainty, So we're going to discount it heavily, imply a 2% buyback. So we're going to reduce some of the shares. And I'm taking a look at the reliance on raising capital. They're debt heavy, and that's because they're buying back shares and not issuing shares as a net negative on shares. So they're debt heavy. I'll explain what some of these other numbers mean on a later video. I've been saying that for a while now, but there will be a moment in time for that. All right, so looking at the growth over the past couple years, they did 4%. So let's do the center one about 4%, and then let's do 5%, and then 6%, and then let's do 2% and 1%. All right, so this is a cheap company. It's just a cheap company. If you what the play is here is that they're able to return capital to shareholders in the form of dividends and buybacks, and then just eke out enough growth, and then you're getting it at such a deep discount that it doesn't need to perform that much. Okay, so a lot of the returns here, it is a mature business. It's not gonna grow like crazy. I actually wouldn't be surprised, by the way, if it actually only grows at 1%. Okay, let me be very clear. And then let's actually take away the buybacks so that we can, see what that looks like. So this is one that if I could get it at about $28, which it was just there, that would have been a very good price. Right now, you're making a little bit more assumptions. You have less of a margin of safety. So I don't think they're going to dilute you, by the way. So I'm not going to even put a negative number at the stage that they're in. They don't need to dilute you. If anything, they're always going to keep returning more and more cash back to shareholders in the form of dividends or buybacks. And by the way, now that we're on that topic, let's broach the idea of whether or not they should be doing a buyback, right? Or dividends. So, we can take a look at a couple things. So we talked about whether or not the stock is cheap, and that will determine whether or not we believe that they should be doing buybacks. Is a stock cheap, Austin? In your opinion, we can have different opinions.
Yes, I would probably say the stock is relatively cheap.
So if you out there agree with Austin,
I also think too that investors are probably looking at the balance sheet and are probably extrapolating from this a risk, and that's being priced into why this is so cheap at the moment as well. I think that's also a very legitimate claim you could probably make in this instance too.
I would not agree.
Really?
A little bit of
Why's
added
that?
nuance. I was invested in Dell Corporation.
Mm-hmm.
Dell for a long time was trading extraordinarily cheap. That one had a balance sheet problem. Okay, this one doesn't. So my thesis on Dell, and I don't own Dell anymore. But I made a good amount of money on it. I purchased it for around 30 something dollars a share. For those of you who might be looking that up right now, what it is right now, but I don't know what it is right now, but I sold that over $100 a share. And uh, what's good about what was good about Dell is that they owned VMware, and the entire value of VMware, they owned 80% of it. The entire value of VMware was almost the entire market cap. I think it was more than the market cap of Dell, what they owned at the time when I was buying Dell. So for me, it was like a layup. That was a layup. So then all I needed them to do was improve the balance sheet, pay down the debt, and they did. And then they spun off VMware. But my point with all that, sorry to pat myself on the back there, that's not what I meant to do, was Dell is a very similar business to HP and HPQ and HPE, except they're not spun off. So Dell does everything that HPQ does and what HPE does for the most part. Except they're not two separate companies. They're all in one. And the PE ratio and the price free cash flow is very low. It's what they normally trade at, to answer your question, Austin. That's
Okay. Okay. So your disagreement with me is basically because of past experience where you looked at a similar company, Dell, and you said, okay, Dell actually has a balance sheet issue here. And yet that was a profitable, I would assume with what you were saying, a profitable investment for you. However, in this instance, even though there's a lot of liabilities on this balance sheet, this is not necessarily, in your opinion, a balance sheet issue. Therefore, that's where the disagreement between.
No, I'd say these types of companies trade cheap.
Okay.
It's like the multiple they receive.
Okay. So these types legitimately just like printers, computers, like Dell, and then HPQ, HPE just trade cheap, period. That's where like the foundation of the disagreement here is. Okay, perfect.
Yeah. Lately they trade cheap. It's not because of balance sheet issues. It's simply the nature of the peer group. The peer group trades around there. So,
and then also the point in time right now too, the peer group, and then the year that of which these peer groups are in, are contributing to it trading cheap as well. Am I understanding this?
Well, yeah, in any given year, the sentiment for a different group can be different. You know, it could, next year people would love these stocks and then they want them, they want all their shares. But for the time being, this peer group is trading cheap. So if you're looking at the entire peer group and they're all trading at the same multiple, it's not something to do with the balance sheet of one or the balance sheet of other. It's the peer group, right? Now looking again, we kind of discussed, it's not the debt. It's not that they owe so much money and they have to pay interest payments. It's not really that. From what HP, and if we think about the business that HPQ is in, they probably have a lot of these liabilities that we have to record under GAAP that aren't really necessarily that big of a deal. Okay. Dell had all of those same liabilities, and on top of that had a stupid amount of debt. Okay. At the time, I think when I was buying, they had about $40 billion in debt, 40 billion dollars in debt. Yeah. And the market cap was around 30 something billion. Okay. It was cheap. Okay. And I was buying it with the full understanding that the risk was the debt, but there were other things to it. And this is not a video about Dell, but it was cheap. It was trading actually at a lower multiple than what HP is trading now on a PE basis. I think I picked it up for, I think like 5 PE, and a cash flow basis is even lower than that because Dell was making a lot of cash, but no one wanted to touch it for good reason. Some people might see that debt and they'd be like, that's not for me. And also Dell had that whole scandal back when Dell took it private. Michael Dell, he took the company private and he kind of shafted investors at the time. So there was that scarring, that bad taste in people's mouths. So they didn't want anything to do with it. But I thought it was a good moment. It's a good time at that moment. But to answer the question, summarize there, HPQ, this peer group, it trades cheap. that could be to the benefit, because while it's trading cheap, these buybacks can be actually very effective. So I like it. I actually do like this business. I'm not invested. I may think about it. I'll consider it. If I got it, if I saw it at a really low price point, about 28, I'd actually make it a decently sized position. I
Mhm.
probably close to 4% of my portfolio probably could go into this. I could see that, up to, by the way. And that mainly has to do with the exposure that I would be comfortable with having with something like hardware. But anyway, let's go to HPE. Or do
Mhm.
you want to have any closing thoughts on HPQ?
I definitely think the business is interesting. It's likely not going to make its way onto my portfolio anytime soon. Just the business itself, what the business sells, what the business does is just not exactly captivating enough for me to make it into the list of requirements of the businesses I typically like to invest into. As you probably know now, I like to
Tell
typically
us.
invest. Yeah, I like to invest in businesses that are the DNA of entire industries. So for instance, LyondellBasell, which, that is a business that provides the DNA for multiple different types of industries. For example, BHP, the huge mining company, that is also another business that provides the DNA for multiple different types of industries. I also like REITs as well. I like to own the real estate. And then I like to see anchor tenants that are grocery stores, basically inflation resistant, recession resistant type of these businesses. These are typically the businesses that make their way onto my portfolio here. Now, I know you might have a criticism where you're like, okay, these are computers. It's the modern age. These are printers. This is the modern age. Obviously, people are going to be using more computers. What are we using now to record this? But I would probably have to say I would have to do more research into this specific business. But at the time being, it's not exactly a business that really interests me compared to some other potential opportunities that I've been looking at in the markets themselves. But that's just sort of my opinion with this.
Okay, fair enough. Um, so taking a look at HPE, they have the same name, but this is Hewlett Packard Enterprise. So Hewlett Packard Enterprise focuses on more of the cloud. So we'll talk a little bit more about what that means, because everyone uses that word these days. And
Yeah.
since its IPO, it's done pretty well, almost up 100%. And taking a look here, they had this little dip in 2020, and congratulations if you picked up shares there, because again, you were almost up 100%. It pays a nice dividend yield, and on a PE basis, it is cheaper than HPQ. This is the growth part of the business that they spun off, and then we were just looking at the legacy business.
Mm.
So let's actually take a look at the presentation here and see what they have to show us. So non-GAAP operating profit, we can see here that it's higher, obviously, because they're dealing with the more interesting, business, right? So they're dealing with the cloud and all that stuff. So 25% margin and then 27% increase, right?
Mm-hmm.
Sorry, 25% increase in operating profit. My bad. Sorry. And EPS grew by 27%. So faster growth. We're seeing faster growth in the previous business. Free cash flow, what we like, cash flow, up 177%. So they're growing that nicely. All right, let's take a look. So core business, and then growth business, and as a service pivot. So they're trying to get to software as a service, or not software as a service, but as a service. So this is like recurring revenue. So we want to see what their outlook is. So their outlook is about 2 billion, so 1.8 to 2 billion in free cash flow. Okay, that's good to know. Let's take a look here. And this is, by the way, for the quarter, right? For the quarter, not for the whole year, I think. I think that's for the, I think that's for the quarter. So let's see here, HPE. So they want to see their orders growing up 100%. Okay, nothing really. This is not as interesting as the other one in terms of what they're trying to show us. Okay, so the different parts, they have storage business. Okay, so this is good to see what their business lines are. So we have their growth part, their core business, and then the as a service enabler, so AAS enablers. Okay, so HPC and AI, quarter over quarter revenue growth. So we want to see down the growth. So they had the most growth in this sector right here. And it's not that small. It's at $1 billion. Intelligence edge, this declined. Okay, interesting. They're struggling there. And then storage, they store data, compute data. Okay, so that's about quarter over quarter, year over year. So actually, oh, this is important. You see that? This went up quarter over quarter 35%, but year over year growth 0%.
Oh,
interesting. So that could be misleading. All right, so going over here,
it's interesting. They put that on the investor presentation.
Yeah, exactly.
Props to them, though. You know,
right here we see the revenue Q4. Okay, so remember when you use that word like yearly cyclical? Yeah, this is yearly cyclical. There you go. So you can kind of see that here, down and up, and down and up. You see here, Q4 seems to be a really good quarter for whatever reason in their business, right? And then looking over here, gross profit. Okay, so we see it up, down, and up. Okay. Operating net cash. Okay, so cash and debt. Cool. Financing company. Okay, so they say they have a healthy balance sheet. We will be the judge of that. But let's just note, they say they have a healthy balance sheet. Okay, I think we're going to skip all this. But again, we see the same kind of level of diversification as the parent company that they came from. We see the product mix as to how much they generate. And I guess they're going to have very similar to their parent company, and the same thing when they separate quarter and year. Okay, so this is artificial intelligence, the AI part. So about $1 billion. I mean, that's like 14% margins. That's fine. And then the United States and Canada is the highest one, of course, obviously. All right, so I think we're going to skip it and then go to the model. Okay, so thoughts so far? Impressed, not impressed, bored? What are you?
Just sort of neutral on it, if I'm being completely honest. Just kind of just
bored.
Yeah, just
tell
taking
me.
like,
Just tell me.
Yeah. I'm bored.
Yeah.
Yeah. Nah, I mean,
to the abyss.
Yeah, I'm like trying, I'm trying to be diplomatic with this, but yes, like this really isn't a business that interests me. That doesn't take away from the fact it might be a great investment, and I do want to see how this performs in the model, and I'll be asking good questions as we go along. But yeah, Fabio's right. So
I know I'm right. I was reading that boy's face from a mile away.
Yeah.
He was going like, all right. Yeah. So if we take a look at the average growth rate of the past 5 years, they actually declined in growth. So not looking good too far. We're going to assume those buybacks, they're going to be doing those buybacks going forward. Okay, so let's take a look at the price to free cash flow. And that's pretty cheap, 5.6 right here. Analysts say this one's a buy, 4.9% upside. Let's jump over the key ratios before we continue in the valuation model. Similar story up here. All right, similar story up here. The debt, take a look at the debt to equity. They do not have negative equity. And then ROA, ROE. Okay, decent. Okay, cool. I'm just zipping through this, guys. You can take a pause here and look over here at this column to see if it's getting better or worse. Okay, actually look at that. Earnings quality passes the test.
That's nice then.
Take a look over here. It's getting worse, but these are still really good. Okay, so we're done with that. Summary report. Let's go here to test some growth rates out. So basically, let's keep this at 0. If you got it below, they could just stick here and stay forever. If they start to grow in the future at like 3%, wow, you don't have to assume any growth with this company. That's incredible. Very similar for both of them. You don't have to assume much, and you're there. I was wrong in my initial assumption to show everyone that this is kind of raw. I thought this was going to be the growth part of the business. It doesn't seem to be the case. It appears to be that HPQ is growing more than HPE, and they spun off this business, I guess, because it wasn't growing as much. But since they're both kind of not priced for growth, if either of them do show some growth, this may indeed be a decent investment. We are discounting the absolute living daylights out of it. We
Yeah.
are, however, assuming some buybacks, but I think at the current price, they are moderately cheap, or very cheap, depending on how you look at it. And so the buybacks are warranted, as well as they do pay a dividend. So it's probably prudent to maybe reinvest that dividend. Looking at here, the return on invested capital is not that strong. So I do agree with the buybacks and the dividend. I would like actually them to increase that dividend, because that is fairly weak return on invested capital. I think
Yeah.
that I could probably do
Would you
better.
kind of walk us through now what the relationship between return on invested capital, buybacks, and dividends actually are in this instance here?
Yeah, so the better the return on invested capital, the more you would want management to actually keep that money and reinvest into the business. So with that's just above the market average rate of return. Um, and so that's not fairly compelling for me to then say, oh, please keep my money and reinvest it. And when I see a very low return on invested capital, um, well, actually, I'll say it depends on the business too. But with a lot of businesses, typically, if I see a low return on invested capital, I would prefer them to return more capital to shareholders. Then I'll go somewhere else and put the capital to work. But this one, I mean, they're doing the right thing. That they're buying back shares, they're paying you a dividend. They're probably going to be growing that dividend. The payout ratio is, fairly low. Plenty of room to grow the dividend. If you're a dividend investor, those are some of the things you probably look for. However, be warned, this is still kind of a technology play. So if they don't keep up to date with the technology trends, they will suffer. And again, they're utilizing more debt than they are utilizing shares to fund themselves. That's what that means, debt heavy. Debt heavy just means they use more debt than shares. And in this case, they have negative share usage because they buy back shares, but they do have some debt. So obviously the model is telling us debt heavy.
And now kind of going into exactly sort of the capital structure that we're looking at here, would you kind of elaborate on the relationship that Coker, the COCR cost of capital, realized, as well as what alternative weighted average cost of capital is for the audience here today?
Well, you mean the alternate?
Yeah. Yeah.
Okay, so the alternate weighted average cost of capital utilizes a completely different formula. I mean, even the estimated WACC is sort of a different formula, because the Coker is taking into account. I said it would be a different video, but I'll touch it here. So Coker is actually the realized cost of capital, which is actually what they're actually doing, not the estimated options, right, that they have. So for example, weighted average cost of capital takes into account the cost of the equity and the cost of the debt, but they may not be using one or the other. They may just be using one of them and not using any of the equity as a theoretical cost. It's that's kind of what the problems are with WACC. If you look up, some of the problems with WACC, that's right there is one of the problems with WACC.
Yeah.
WACC
So
is pretty good.
This is sort of your solution to WACC in this instance, if I'm understanding this correctly.
Yeah.
Yeah.
It's kind of like looking. It analyzes the business. It's like again, it's not end all be all. It's like a flagpole to kind of see, okay, what's going on underneath the hood. What is management doing? And the Coker, I'm pretty sure it doesn't exist in the internet. You look up Coker and it doesn't exist. Do it right now, Austin. Tell me if you find Coker.
I will. Yeah, I will.
I'll be surprised because anyway. So basically, it takes into account the actual doesn't exist. Yeah.
Nope.
So yeah, of course. So it takes into account what management actually utilizes in terms of the cost of whatever they're using to fund the business. And so if they're not using shares, why would we compare it to the cost of equity instead? But alternate WACC will take the traditional formula of WACC, but then just calculate the cost of equity in a slightly different way. And then on the final product, when we release it on our website, it's and it's not the current website, it'll be a new website launch. There's going to be an even more complex one. Of course, I don't want to overwhelm everyone, so these will be like off to the side in like advanced menus. So if you don't even want to look at this stuff, you don't have to. These are just tools that will help you in further making more informed decisions if you so choose. And then we will hopefully do good enough job through videos at explaining what each one means, and then how you may utilize these tools, because they are tools at the end of the day. They're not going to do the work for you. They're just going to help guide you in the thought process. But alternate WAC takes into account, for example, beta and the correlation with the broader market, stuff like that. So not to bore everyone with math, but the alternate WAC is WAC with a little different flavor to it. And even the estimated WAC, there's a little different flavor to it, but that's why I put estimated with an asterisk. Anyone can do the WAC formula. You go on an Investopedia and you can do the WAC yourself. It's not too difficult. Dilution accretion doesn't really serve well for this. I would use dilution accretion for businesses that are diluting you. So in a business that's not diluting you, ignore it. Okay. So I'll remind me to tell everyone that every time. In the final product, again, this will be like hidden away. You can just hide it and not worry about it. And then there'll be like a better drop down menu. I mean, here I can kind of do that in Google Sheets. It's like a little drop down menu here if I don't want to look at it. But dilution accretion, ignore it if the company is not diluting you. Okay, that's more of a measure, and we will explain that when we find a company that is diluting you and we're plugging it into the model. With that being said, Austin, I'll say both businesses, interesting, very cheap, don't have to assume much growth. I didn't finish writing the growth rates because I kind of made my point, with both of them. So I think in the HPQ, I did populate the full growth rates, but I think I made my point that they're both trading very cheaply.
And then also just given some of their peers too, their peers all tend to trade cheaply as well. Because you and I had that disagreement about that earlier, where I had thought that some of the balance sheet, the health of the balance sheet was priced into this cheapness, and you were like, no. And then you
bonus part of the video, everyone. If you come what you've seen here, this will be the bonus part of the video. We're gonna go look at the HPQ balance sheet. Okay, so at this point, you guys can click off. You've heard our opinions or what we think about these two businesses. Cool, they're cheap. They may be good investments. Decent margin of safety in them. But let's take a look and answer that question once and for all, Austin. So we're looking at HPQ. This is for you and me. Take a look at the data dump. All right, so let's go to the balance sheet. And
here we are. I would zoom out a little bit too. Yeah.
It's going to be less professional, everyone, but if you're still with us. So let's take a look here. So long-term debt. You see it's not that big. Unearned revenue. Okay. So unearned revenue is not that much.
It is accounts payable, Fabio.
It is accounts payable. Where you see accounts payable? Oh, right there.
Right there.
There you go.
Yeah.
So accounts payable.
From earlier. Yeah, when I had talked about, was it potentially accounts payable? We just got our answer. It is accounts payable. That's their largest liability, actually. Wow. Yeah, that is massive.
Yeah. And why do you think that is?
Because we saw that in the cash conversion cycle, they're getting the cash faster than they're realizing sales. So then I would likely assume that same scenario is happening when it comes to paying their credit, basically.
Paying their suppliers.
So
that's not is that necessarily a bad thing?
That's something during a deep dive we would really have to determine, because I can't even say, like, I could literally sit here and be like, yes, it's a bad thing, or no, it's not a bad thing. But like, I don't have the foundational basis to determine if that is or is not a bad thing or not.
You're killing me. You don't need that. Because my hypothesis, when you look back at the video, I thought it was a mixture of accounts payable and unearned revenue. Turns out unearned revenue is really small. It's there, but it's not a big deal. It's entirely accounts payable, and the accounts payable section, think about it like this. You have a business and you get your supplies, right? You make the product and you sell it. You don't have to pay your supplier for a decent amount of time. Is that good or bad as a business?
Intuitively, I would say that's good, because then
That's
you're
really
retaining
good.
cash. Yeah.
That means you have essentially you have power. You
Yeah.
have power with your suppliers. Because always the time value of money, you want the cash immediately. If
Mhm.
you and I are doing a business and we're selling supplies, we want the cash immediately. We get the cash immediately, that's the most valuable to us. If we give someone a product and then we don't get the cash for a year out from now, that cash in a year out from now is less valuable, not because of inflation, but because the opportunity cost that exists, time value of money. So if you're telling me that basically we can get the stuff on credit and then we can sell it, right? Remember, oh, one of your favorite categories
I know
does this.
exactly.
Yes. Which
I know
one?
exactly where you're about to go with this.
Which one? Come on, give it to
Grocery
me.
stores. Grocery
Exactly.
stores.
So
Yep.
grocery stores operate on the same kind of business model. Well, what we're seeing here is that HPQ operates on that same way. That's not a bad thing. So you see, this is that nuance. So the one I'd be always worried about is that long-term debt. That long-term debt is very serious because that's interest expenses, and if you can't pay those, you're done for. But the
Well, yeah,
accounts
and that
payable,
also opens you up to macro risk as well, macroeconomics risk. But that's a topic for a whole separate video. This video is,
we'll do that video.
the show. Yeah, yeah.
But the accounts payable, yeah, it's there. Oh, and we forgot also accrued expenses. Accrued expenses is actually huge too. Look at that.
Mm-hmm.
Yeah, look at
That's
that.
also a pretty sizable pension expense too.
Where do you see that? Oh, the this one right here,
Yep.
down here.
Yep.
I mean, it's only 1 billion.
Yeah, it still makes up a good portion of the long-term liabilities though. It's
True. Yeah, it is, because total long-term liabilities. Well, total liabilities is 40 billion though. It's 1 out of 40 billion.
yeah.
That what you did find that this one, the accounts payable, that's the disgusting amount of it, right? So
Yeah.
more than half of it is current liabilities.
Now I'm also
That's
curious about
crazy.
something else. Can you scroll up super fast and just show me the cash number? Interesting. Okay.
Mhm.
Interesting.
Yeah. So let's take a look at the receivables. So what the way you would kind of check this out is what is the revenues? Okay, so so no, everything kind of checks out. So from the revenues, I guarantee you that they're expensing out and they're paying those payables. Look at that. Look at those sales. So they're taking their inventory, they're building the product, assembling the product, selling it. We see that in the revenues. Then part of the expenses of those products, right, goes in here. It's more than likely right in here. The cost of revenues. Where is that? Cost of revenues. So yeah, right there. So in the cost of revenues, they're more than likely paying off those accounts payable.
Okay.
That's where
Yeah.
that's coming off. They're expensing that account.
Okay.
So
Yeah.
that's probably I'm gonna lean on that because otherwise they're a dead company.
Mhm.
And I don't
Yeah.
think they're a dead company. Uh,
Yeah.
so if that's not the case and those accounts payable are some other thing, which I'm fairly certain they aren't because of the context of what business they are, they don't build everything. They don't build the GPUs. They don't build the CPUs. Does that make sense? They don't build
It
that stuff.
does.
They're
Yeah.
going to pay Intel for that. They're going to pay AMD. They're going to pay NVIDIA. And then they get those parts and they assemble, then they sell it. And then that's reflected in their high revenues right there, the 63 billion. Then they take that money, they pay off their suppliers, well, bada bing, bada boom. So good thing we identified that. I was leaning on it. It was a mix of both. Turns out it's entirely the accounts payable. They don't have really unearned revenue. And in fact, I should have actually seen that better because in the presentation, I think the smallest part of it was enterprise. I think enterprise was only $1 billion. So, which is nothing. So therefore the unearned revenue number wouldn't be high. So yeah, it's the accounts payable and accrued expenses. Accrued expenses is something.
All right. Well, Fabio, do you have any closing thoughts before I wrap up the show here today?
Not really, no.
I think we've covered. I think for a
Well, that was the
preliminary
bonus
analysis.
section. Yeah,
Yeah, I think we've covered these pretty in depth. But if you guys
Austin
have
is
enjoyed, yes.
extremely bored with this.
Well, I mean, I'm never like bored, but yes, these businesses bore me. If I'm being honest, I'm bored by this business, but I mean that in like a loving way. If you're
All right.
invested in this and you believe in this, good for you. You know, awesome. I really hope your investment performs great, and I actually like genuinely mean that. But just me personally, like I would never invest in these, but that's just me personally. You know, that's just my personal opinion. So,
well, Austin, your opinion is full.